Hey everyone, welcome to question 4 of the FIN117 main exam. So this is a fairly short question in the description, so probably because they've given us such a hard question in question 2 around financial instruments that they're starting to take their foot off the accelerator now in terms of difficulty. This question, what it's asking us to do is to prepare the journal entries required to record the transactions in the books of Japstar. Okay, so pretty generic question. What are the journal entries? That doesn't give me any insight as to what the type of question it is, like what category of question it is. So if I read the background information, I can see straight away that it's a lease question. IFRS 16 leases, the new standard. So Japstar has entered into a lease agreement for a new packaging machine. The lease contract gives Japstar the right of use for the machine for the period of the lease. The machine is an identified asset and is a lease for the purposes of IFRS 16. And they use IFRS 16. So the lease commenced on 1 July 2016, and it includes the following key terms. Lease payments, 5 equal payments of $100,000 to be made in advance. The first payment is due on commencement date, and the final payment is due on 1 July. Use of packing machine. There are no restrictions imposed by the lessor on Japstar's use of the machine. However, Japstar is required to insure the item for accidental damage. Number 3, purchase option. Japstar has the option to pay $200,000 on 1 July 2021, which will result in the transfer of legal ownership. At the lease commencement date, Japstar is unsure of whether it will exercise the option due to uncertainties over the future sales of its product. Return of the machine to the lessor. If Japstar does not exercise the purchase option, it is required to return the machine to the lessor on 1 July 2021. The lessor advises Japstar that the interest rate implicit in the lease agreement is 8%. If it were to borrow to acquire the packaging machine, Japstar's incremental borrowing rate would be 9%. Japstar paid a 12-month insurance premium of $5,000 on 1 July 2016. The useful life of the machine is 10 years, and Japstar uses the straight-line depreciation method. Right, so we know that it's going to be a finance lease, not an operating lease, because of various elements in the question, but we're not asked about identifying that, but it's implicit that you must know this because the journals that you put in your exam are going to be dependent on whether it's a finance lease or an operating lease. So you should be able to identify pretty easily this is a finance lease. The reason is they're paying off the majority of the fair market value. They have the right to acquire the asset, and it seems to be some sort of specialized equipment as well. So you should know all of those things off the top of your head. So we know it's a finance lease straight away. So what I would do now is to open up your exam Bible template. After that, look for the leases, because we're going to be doing a lot of journals. This is going to be really important. So the first thing is, what type of lease is it? We know it's a finance lease, so make sure that you're using the right one. And also, sometimes you get a question from the view of the lessee, i.e. the person who's taking out the asset. So you might be an aircraft manufacturer, or you might be an airline. So the airline would be the lessee, and the aircraft manufacturer might be the lessor, the person leasing it out. So that's another trick in the question, is make sure that you're actually accounting for the right person in the equation. So okay, so here's our table here. This is what we need to do. It's got all our journals and the calculations we need to do. So first up, what I want to do is bring up an Excel calculation, and I'm just going to create my table over here to align with what's in that table over there. So first of all, I'm going to have my years. So I'm going to have year 0. So year 0 is like as soon as you sign the contract, basically. Okay. So how many years do we want? We only want up to 2020, and we're starting in July 16. So let's figure out what that's going to equate to. So we're going to go 1st of July 2016. Okay, and then we want the years all the way up to 2020. Okay. Okay, next is the payment. Still reading off the table over there. So payment. We know from the question that they're paying $100K a year, fixed fees, with one payment to be made in advance. So let's make sure that that is reflected here. So we've got 5 payments, cool. What's next? It's a PV factor. So PV factor you should be able to get from the end of your exam. Your exam paper should have a table. Let me just bring it up. We're on page 11 currently. Here we go. So we need to know what the present value factor is. And we're using an interest rate of 8%. Present value of $1. 8%. Here we go here. So I'm just gonna see the alternative is you just use the formula. See this formula over here? 1 over 1 plus 8% divide in brackets to the power of n, with n being the year. That will also calculate it, but it's probably a bit faster in the exam just to plug in these rates like this. So year 0 is always going to be 1 because $1 in today is worth $1, so we times it by 1. But for these other years, 1 year in advance, it's going to be 0.9259, and then it's going to be 0.85734, and then it's going to be 0.79383, and then year 4 is going to be 0.73503. Okay, let me just double check that I've typed all these correctly. So I've made a spelling mistake there. 79383, 0.85734. Just be careful when you're doing this. 0.92593. Alright, perfect. Now let's go back to page 11. Alright. And then bring up the exam Bible. And then finally, the last column is PV cash flow, which you can see in the exam Bible is calculated as the payment times the present value factor. So it's going to be the payment times the present value factor. Drag that down. And then finally, the present value of the minimum lease payments is equal to the sum of this above. Okay, perfect. Alright, so let's go back to the question and figure out what the journals that we need to do. So the journals are all down here, right? So the initial recognition is just the right of use assets. So it's literally just going to be now for each of these, again, because they're easy marks, make sure you've got a description, a date, a debit and credit. Make sure you've got your dollar sign and it's represented correctly. So if you're in a thousands, you write dollar, thousand. Or if you're writing in dollars, make sure you write dollar. Maybe even write your currency as well, so $1. And then at the bottom, write a description. So you'll notice how in the exam Bible it's got an example over there. So make sure you include all of the key areas, because if you don't include one area, you could potentially lose the mark. And you don't want to throw away a right answer just because you didn't do something right in the formatting. So just be really careful on that. So the first one, I'm not going to type out everything just for the sake of time, but you need to do that. So account, and then you've got your debit, you've got your credit, and then your description down below going blah, 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 blah. So we can say initial recognition of lease, asset, and liability. So we've even got a description example that you can just copy and paste in the exam Bible template over there. So what we know is right of use asset. I'm not going to type it out. You know what I'm trying to achieve. And then lease liability. So the debit is going to equal to the present value, as is the credit. So there is our initial journal entry. Alright. Okay, the next journal that we want to post is the initial recognition. Sorry, we've done the initial recognition. The second one is going to be to do with the actual payment of cash. Now keep in mind, the first year is always a trick because there's not going to be any interest and there's not going to be any depreciation because we're posting this on day one. We're not posting it at the end of the year. So whilst this journal over here does have depreciation and interest expense included, what it should say is if it's year 0 or if it's the first one, in the same year, on day 1, you don't need to recognize depreciation or interest because you haven't owned the asset for a full year. So all we need to do now is just take the top one and the bottom one. So the lease liability, think about it, you're repaying cash, you're paying off your loan, your cash is going to go down, so it's going to be a credit. It's going to be 100,000. I'm going to link it in to the present value, and that's our second journal. And this is to record the lease payment made in advance. Okay. I just want to check back in the question, make sure we haven't missed any key things before I close off the 1st of July. And this is a habit you should get into as well. Even if you're happy with it, just go back to the question, read through it in case you've missed something. You might pick up a trick as well. So something that I've noticed in here is that they've also got this insurance premium in here that we need to record the journal for. So the journal for that's basically pretty simple. You don't need any template for that. You can figure it out. It's just going to be insurance expense, credit cash. So it's going to be 5,000, 5,000. Pretty straightforward. And that's also on the 1st of July. Okay, so back to the exam Bible. Now remember what we mentioned before about the depreciation and the interest expense. These are all currently combined because it's assuming that the payment and the depreciation and the interest are all calculated at the end of the month. However, in this question, the lease payment is paid on the 1st of the month. So we actually need to split them up into 2 different transactions, unfortunately. But there's still going to be depreciation. There's still going to be interest, but it's going to be at the end of the year. It's not going to be on 1 July. It's going to be on 30 June 2016, or 20X6, I should say. And let me just add the description here. You know what? I just realized we missed a step down here, which is the lease payment schedule. So we've filled out this lease liability calculation, but we also need to do the lease payment schedule. So let me just do this over here. So the opening balance. So this is our present value of minimum lease payments. We've also got this lease payment schedule over here. So we've got payment date. We've got our opening liability, which is the present value. It's 431K. Next, we've got our lease payment, which is equal to 100K. Then we've got our liability reduction. And our interest expense. Purely just following off this table down here. And then closing liability. Okay, so the present value, lease payment's $100,000. Liability reduction is equal to B minus, so the lease payment minus the interest expense. So the interest expense is going to be equal to A, the opening liability, times the interest rate, which we know is 0.8%. So it's 34,497. And our liability reduction is equal to B minus D, which is equal to the lease payment minus the interest rate. I don't think we actually need to do this whole table because we only need 1 year of interest expense. I just realized We don't need 5 years. But generally you would need to do this lease payment schedule. But what we can do instead is just think about it logically. So what's happened is we've got this minimum lease payment of 430k, right? We then paid off 100k on day one. So actually the minimum lease payment is actually the 331,213 amount, okay? Next, we want to times that by the interest rate, which we know is equal to 8% per the question, 0.08 interest expense. And then if we go back to the journal down here, the interest expense is going to be, well, the other side's going to go to the lease liability, isn't it? Because it's going to increase the lease liability. Going to go the opposite side of that to record the lease interest accrued. And then the date for this one is going to be 30 June 20x6. Okay, and then finally, we also want to add in the depreciation journal that we've got up over here as well. So this should be the final journal for this particular year. Also going to be at 30 June. We all know the journal is going to be depreciation expense, and then it's going to be accumulated debt right of use asset. Just write it out in full in your own exam. So the depreciation, if we have a look at what the background question gives us, we know that the value of the assets 431,213 is the present value of the minimum lease payments. That's the value of the right of use asset. All we got to do now is divide it by its effective life. So I can see, so this is a trick part of the question, because it says in here the useful life of the machine is 10 years. However, what you should remember is this trick here is that the effective life for depreciation is not the necessarily the years that's dictated, but it's the useful life of the asset by the person who uses it. So if that number is lower than the typical useful life, then you have to use the lower number. So that's the trick of this question, because in this, the Japstar is the one using the equipment. It's relatively specialized equipment, so it's really how long Japstar will use it before it's replaced. And if you look at the terms of this lease agreement, they're going to use it for 5 years, and then either give it back or purchase it. So the useful life for Japstar is actually 5 years, not 10. So this is the trick of the question. It's probably going to separate the merits from the non-merits. And the more exams you do, the more examples of these little trick parts that are worth maybe 1 or 2 marks. You get a bunch of them from experience and be able to pick them up in the exam. You'll be able to get a merit really easily. So it's just about doing as many exams as possible. Okay, so it's that, divide by 5, and then the bottom should equal the same. So that's pretty much it. That's 10 marks right there. There's 5 journals, 2 marks each, 10 marks in total. So let's move on to part B. Let's have a look. So it's worth 10 questions. The exam for part B, the question for part B is saying, prepare the consolidation journals. Okay, so we need consolidation journals. That's worth 6 marks. And then part B is identify if items 2 and 3 have an impact on the calculation of non-controlling interest. Explain your reasoning for each of these items. You're not required to prepare any calculations or prepare any journal entries. So that's worth 4 marks. So it's not a lot of marks, so I don't think it's going to be a particularly difficult question, but it is on consolidation, which can be a tricky topic sometimes. Okay, so we've got Petrie Limited, which is a reporting entity. Petrie required a 55% controlling interest in Snappy on 1 July 2016. The financial account is preparing the consolidated financial statements and is seeking your assistance with the following items. So number 1, gain from a bargain purchase. So the bargain purchase is basically the opposite of goodwill. It's basically the assets that you pay for the company are worth more than what you paid for it. So the fair value of the consideration transferred by Petrie was, to acquire the controlling interest, was $1.9 million. On July 2016, an acquisition analysis was completed showing a gain from a bargain purchase. To comply with the requirements of business combinations, the fair value of Snappy's net assets were reviewed and found to be correct. This confirms that the gain from the bargain purchase is correctly calculated. At the acquisition date, the identifiable assets and liabilities of Snappy's were recorded at fair value and represented the following. Share capital was $6 million, retained earnings was -2, so total equities were $4 million. Okay, so it was a $300,000 gain from bargain purchase, $300,000 gain from bargain purchase. Okay, in June 2017, which means they paid $3.7 million for it if there was a gain. Sorry, that's at 100% level. In June, okay, number 2, inventory sale. So in June 2017, Snappy sold inventory to Petrie for $110,000 and made a $30,000 gross profit on the sale. Snappy would normally make a $40,000 gross profit if the sale was made to an external customer. At June 2017, Petrie has not sold any of this inventory, but had paid for the inventory purchase. It's a $110,000 inventory sale. And then finally, number 3, management fee. Petrie charged Snappy a management fee for helping to oversee Snappy's business for the year. The fee was still to be paid by Snappy at the end of the reporting period. This was $400,000. So the tax rate's 30%, both have a 30 June year end. Okay, alright. So it's consolidation, and basically the general gist of what you have to do with consolidation is you look for any related party transactions, because if that's not genuine sales, or if it's not a genuine transaction, then you have to reverse it out. Okay, the first thing that I want you to do is open up the exam Bible and go to accounting for subsidiaries. The reason I'm choosing this one is because it's to do with reversing out a controlling interest of a company that's owned by the parent co. So that's subsidiaries. If I click on subsidiaries, now generally these subsidiary questions can be like 20 marks. And there's generally lots of different journals in here. This is obviously a very condensed question. Sometimes they can make it a long question, sometimes they can only just look at a few things. So basically what that means is we don't have to deal with a lot of this calculation. Some questions ask us to calculate what's the goodwill amount. In this question they actually give it to us, and it's the opposite of goodwill. It's a bargain purchase, so it's negative goodwill effectively. But yeah, in the longer questions you have to actually calculate what goodwill is, and then you'll have to do all of these journals down here, right? But the only thing we care about, for us at least, is this step here, which is eliminating the investment asset. Basically, what we want to do is eliminate the parent co's controlling interest in the assets or the business combination journals from this acquisition by Petrie of Snappy. So the journals that we want to do is we literally just follow this table down here. Okay, so we want to reverse out a few things. So we're going to do our usual date, account, debit, credit. The date's going to be 30 June 2017, which was the year of acquisition. Okay, so let's follow this guide over here. So we've got share capital, and see it says in brackets, note only the parent's percentage. Share capital. Then we've got retained earnings. Then we've got reserves, if there is any. There's none in this question. And then there's the goodwill. Goodwill slash gain on bargain purchase. Yep. And then after that, let's see. It's just investment. So investment in Snappy is the name of the company. In Snappy. So this is literally all we have to do. So let's start with this first one, the debit, the share capital. So the amount in the question that we're being given is $6 million, but we only want to recognize 55% of that. So the debit that we're going to do is 123. We want to times by 0.55. And that's only going to recognize the component that the parent company owns in Snappy. So next is retained earnings, and we're going to do the same thing. So it's 2 million in retained earnings. 1, 2, 3, 1, 2, 3. We're going to times that by 0.55. Cool. But I just remembered this is negative. So I've actually got negative retained earnings, not positive. So we're going to have to move this to the credit side because it is negative. Same with gain on bargain purchase. So normally the goodwill would be a debit. So if it was a goodwill of 300,000, what we would do is we'd write 300 like that. But because it's a gain on purchase, we're also going to have to move it across to this side as well. And then finally, investment in Snappy, this here, is just going to be the balance. So it's going to be that minus the sum of that. It's 1.9 million. Okay, that's pretty much how we account for this first one up here. But next we also have to adjust for these items down here. So the management fee and the inventory sale. Okay, next up in terms of what we have to reverse out is you eliminate the intergroup transactions and balances. Note that it says transactions and also says balances as well. So the obvious one here is number 2 in the main background information. So it's saying inventory sale of 110k. So this was sold from Snappy to Petri. So this is one company within the group selling to another company within the group. So what we have to do is we have to reverse out the sales. We also have to reverse out the cost of sales as well, because it's all owned by the same company really. So what we're going to do is we're next going to go also at 30 June 2017. We're just going to go very simple, debit the sales out, credit the cost of sales. So sales is going to be 110, cost of sales is going to be, and of course if one business is selling, it's also going to have, you know, the inventory. So one business is going to have cost of sales 30k, like so. So if they're selling it and they're going to make 80k, they're going to have a cost of sale of 30k, and they're also going to have the inventory on the other side of it as well, 30,000. So this is to reflect the intragroup sales, and this one is to reflect the unrealized profit on inventory sale. Cool, almost there. The final one is just this management fee. So again, similar to these other ones, we just need to reverse it out. Let me just have a look. Oh, we're also forgetting the tax impact as well. So we need to include the journal for that. So you can see sales, offset cost of sales, then you've got the cost of sales inventory. You can see the formula for that, and then the DTA, which is just 30% of that cost of sales. So it's 30% times, let's just combine it into a single journal. So I'm going to go DTA, income tax expense. That's purely just taking it from these two lines right there, DTA, income tax expense, and that's going to be equals to 30% of that. Okay, and then we can move on to the final journal, which is just the management fee. I don't have anything written there, but it's fairly straightforward. It's literally just reversing out the management fee income of 400k and reversing out the management fee expense, and then we also have to reverse out the balance as well, so the loan and the payable, because it does say in the question that it would be put towards their loan. Yeah, the fee is still to be paid by Snappy at the end of the reporting period. Okay, so The journal for that's effectively just going to be management fee from one company and management fee expense on the other side. The amount's going to be 400,000, and then we're going to have the loan payable as well. So we're just going to go loan payable, loan receivable, and that's going to be 400k as well. And that's it. That's pretty much all you have to do for that question, for part A at least. Now for part B, it's a little bit different, but it's only 4 marks. So identify if items 2 and 3 have an impact on the calculation of non-controlling interest. Explain your reasoning for each of the items above, noting that you're not required to perform calculations or journal entries. So these 2 ones here, what's the impact on consolidation effectively? Think about it, within those 2 items, there's 4 kind of transactions, or there's transactions and there's balances, right? So there's 4 elements. There's 1 transaction in each category and 1 balance in each category. So for example, for the sales of item 3, we've got the intragroup sales is 1 impact, and then you've got the balance as well. So the unrealized profit in closing inventory, and then you've got the management fee for the management fee, and then you've got the intragroup payable. So it's transaction balance, transaction balance. So we have to figure out, is there an impact on NCI? The answer is, well, the only impact here that's actually going to be impacting NCI is this one, the unrealized profit, because the partly owned subsidiary made the sale, therefore the NCI is adjusted. If it's coming from the top entity, or if there is no unrealized profit margin, then there doesn't need to be an adjustment. So that's basically the reason there. So the partly owned subsidiary made the sale, therefore the NCI is adjusted. Okay, and that's pretty much it. That's how you get 20 out of 20 for question 4 and get 100% in exam FIN117.